Hi class, in this video we're going to review some homework examples from chapter 6. So in this video we're going to talk about closing entries. So if you've read the textbook, you know that there are 4 steps to closing out our books. There's 4 different journal entries that we're going to use or to do to close out our books. First we're going to close our revenue. The next thing we're going to do is close our expenses. The third thing we're going to do is close our income summary. And the fourth thing we're going to do is close out our withdrawals. So before we actually get into any homework, I'm going to talk to you a little bit about the income summary account. So I've actually got a little picture here. I think that may be helpful. So there is going to be an account that we use during the closing process that you haven't seen before. It's a temporary account. It's only used during the closing process. And we call that account income summary because it essentially summarizes the income for the period. So in my little picture, you can see here that I have a funnel, and that's how the income summary account works. It works like a funnel. So when we use the income summary account, we're going to pour our revenues and expenses into that income summary account. Whoops. And that's going to summarize the income. So if you think about what the income statement looks like when we did the income statements in Chapter 4, Chapter 5, the income statement has revenues, it has expenses, and the bottom line of the income statement is our net income. And that net income increases the value of the owner's capital. So that's basically what we're going to do for the income summary. We're going to pour the revenues and expenses into that income summary account, and it's going to pop out the other end our net income, or if it's a bad year, it's going to shoot out the net loss. And that net income or net loss is going to affect the owner's capital. So that's really the function of the income summary account. We're going to close our revenues into it. We're going to close our expenses into it, and at that point, that income summary is going to contain our net income or net loss, and then we're going to close that out to the owner's capital. So that's just kind of my little picture of how that works. So let's jump back over here to the homework and look at some examples of closing. So this one says we've got ledger accounts. This is the end of the period. We've got balances, and it says all accounts have normal balances. All that means is that for assets normally have a debit balance, and if you'll notice in this balance column, it doesn't say debit or credit, so you just have to figure that part out. So all of our assets have normal debit balances. Accumulated depreciation is a contra asset, which works the opposite of an asset, so that has a credit. Accounts payable is a liability, so that has a normal credit balance. Capital has a normal credit balance. Drawing is a contra capital account, so it has a normal debit balance. It works the opposite of the regular capital. Fees income is revenue with a normal credit balance, and all of your expenses have normal debit balances. So if you have trouble remembering what has normal debit and what has normal credit balances, you can look at the Accounting Basics worksheet that I posted in Blackboard under the syllabus. That gives you a list of how each account works as far as debits and credits. Or you can go back into your book in chapter 3, and you should have some pictures and illustrations of how these accounts work. So you'll need to know which are debits and which are credits so that we can close them. So then it says prepare the closing entries. So we've got a whole list of accounts here. We got assets, liabilities, equities, revenue, and expenses, and we're going to close out the temporary accounts. Now the temporary accounts are the accounts that need to be zeroed out at the end of the year because they measure net income. So I like to think about that like your tax return. When you file your tax return at the end of the year, you don't file a tax return and report all the money that you've made forever for your whole entire life. You're going to just report your revenue or your income for this one particular year. And the same thing, if you report expenses on your tax return, you only report them for 1 year. And then next year, you're going to start over, and you're going to start a tally of your revenue and expenses for the next year. So the things that start over or that are temporary accounts are your revenue and expense accounts. So right here's our revenue, here's our expenses, and the only other one that we're going to close out is that withdrawal account, which works kind of like an expense account in terms of it being temporary. We measure it by the year and then we start over the next year. So from drawing and then your revenue and your expenses, we're going to close those out because those are temporary accounts. The other accounts you don't really have to worry about because they're going to carry over from year to year. So to close our revenue, revenue normally has a credit balance. So to get rid of a credit balance, we're going to do the opposite. We're going to debit it. So that was fees income. And this is where our little funnel account comes in. We're going to credit income summary. We're going to pour that revenue into income summary. And our balance was $357,660. So that's the amount we're going to close out. It's going to come out of our revenue. We're pouring it into income summary. That's all there is to the first step of closing. In the next step of closing, we're going to do basically the same thing, except for we're going to do our expenses. And I thought I was trying to be smart and start this ahead of time, but I think we have to move some. So basically, I took all the expenses from up here, took their balances. These are debit balances, so to get rid of them, we're going to credit each one of these. For some reason, it didn't keep my skip line, so because we have to put debits first, so I need to put a debit at the top, so that's why I'm doing this. I'm going to move depreciation expense down. So I'm taking that $20,560 and moving it to the bottom so I can clear up a space at the top. All right, so once you get all your expenses in, that's what that should look like. You're going to add all of these together, and that's going to be the amount of the debit. So let's see what that adds up to be. All right, looks like $243,760. And again, we're going to use that funnel account. We're going to pour all of these expenses into our funnel, which is income summary. If I can find, oh, there it is. And I'm going to check because I might not be able to do math today. Make sure I do my math right. So that's the first two entries. That's step number 1, close your revenues. Step number 2, close your expenses. Let's go back to our worksheet. Step number 3 says close the balance of the income summary. So if it helps you, you might consider getting a scrap sheet of paper and using a T account and just looking at what happens to income summary. So income summary is only used during this process, so it started out with nothing in it. Ours is an empty funnel, and to start with, we put $357,660 in it. So let's just do this. Let's make that income summary, and whoops, and it should be a credit. I don't know why I did that. Just move it over there. All right, so there's my T account, $357,660, and that was where I closed out my revenues. So the next thing that happened was I closed out my expenses, and that was step number 2, $243,760. So there's my expenses. So at this point, that's what I have in my T account, and I erased my little line there. Okay. So let's see what kind of balance we have. So at this point, we have a credit balance and income summary of $113,900. So step number 3 says close out income summary. So to close out income summary, we need to get rid of that $113,900 credit. So to get rid of that, we're going to have to debit it $113,900. And that should come out of income summary. We need a credit. So we have summarized the income. If we look at our income summary, that's actually the net income, because if you remember, that's your revenue. Those are all your expenses. The difference between those is your net income. So we've summarized the income. That is your net income. We are now closing that net income out into the capital account. And if you recall, there's our, in this case, Aretha, whoever she is, Aretha Hinkle. That's her owner. Her capital's increasing. She's happy. And that's all there is to step 3. That closes out your income summary. The last step is to close out your withdrawal. And it looks like she took out $12,400 out of her business this year. So that normally has a debit balance. Withdrawals have a debit balance, so we're going to credit it to get rid of it. Always put your debits first. That $12,400 comes out of her capital. It decreases her value in the company. So that's just how step number 4 will work. So once you get finished with your closing entries, they should look something like this. Should have 4 of them. Close your revenue, close your expenses, close your income summary, close your withdrawals. So that's all 4 closing entries. And then it says post transaction to the ledger accounts. You're going to do this the same way you've done it in the last few chapters. Here's your ledger accounts. You're just going to work your way down. Don't forget to put in your balances. They are up here. And then start working on your journal. Just go down one by one. All right. So I'm going to actually go backwards to a previous problem because I want us to look at this income summary account. It says the income summary and Linda Carter capital accounts for Carter Production Company at the end of the accounting period follow. So we've got our income summary account, our capital account, and it asks for some amounts. So I just wanted to look at this one because this is going to kind of show you how to read that income summary account. It says the total revenue for the period is. Now, if you recall in the previous problem, we closed revenue and we closed expenses into income summary, and we close revenue first. So the first thing that happens in that income summary account should be the revenue. So that's the revenue. The next thing it says total expenses. Well, that's the next thing we closed out to income summary. So that's the $34,700. So there's your revenue. There's your expenses. The net income is the difference between the two. It's also the amount that you closed out to zero out that net income. Zero out that income summary account. So the third thing is your net income, or it could be net loss if you had a net loss for the period. And the owner's withdrawals are closed out to the capital account directly. Was the last thing we did. That's that $9,800. So that just kind of shows you how to do that chart. Let's look at one more. All right, so here's a worksheet, one of those awful worksheets we had to do in Chapter 5. Remember, we have sets of columns, so trial balance has debit and credit. Here's our adjustments, debit and credit. You have to watch these a little bit because the columns, their titles are a little bit off, so you just kind of have to pay attention. There's your adjustments. There's your adjusted trial balance, debit and credit, income statement, debit and credit, and balance sheet, debit and credit. So just be careful you're in the right column. This says record the adjusting entries in the general journal, then record the closing entries, and then you're supposed to post and do a post-closing trial balance. I wanted to look at this because I wanted to make sure you understood how to post from a worksheet, because this is a little bit different. So here's our adjustments. So to do the adjusting entries, you're going to need to look at these two columns, your debit and credits under adjustments. And I see an ABC credit, an ABC debit, so there must be 3 adjustments. All right, so it says record the adjusting entry for supplies. So we're going to find supplies and see what happened in adjustments. So there's a credit to supplies of $1,500. You have to find the matching one, which they've got them labeled ABC, so that's helpful. So supplies and supplies expense goes together for $1,500. So you're just going to record them exactly how they were up there. The debit was to supplies expense. The credit was to supplies. And that one's done. Advertising was probably B. Yep. For $2,100, we're going to decrease prepaid advertising and increase advertising expense. And advertising expense was the debit. Prepaid advertising was the credit. And that one's done. Depreciation should be depreciation expense. C, and accumulated depreciation for $1,500. The expense is the debit. And the contra asset, which is accumulated depreciation, is the credit. And that one is done. All right, so then record the closing entries for revenue. We're going to do exactly the same thing as we did in the first problem I showed you, except for instead of having just a list of account balances, you've got them in the worksheet format. So remember, those are your income statement accounts. There's your revenue. You're going to close first, $49,350. Revenue is normally a credit, so we're going to debit it to get rid of it. So there's our fees income, goes into that funnel, income summary. The next thing you're going to do, and you're still in that income statement column, which is, again, kind of the columns are a little bit mislabeled, but it should be a whole string of debits. So right here, you've got supplies expense, advertising expense, depreciation, salaries, and utilities expenses. So you're going to, these are all debits. So the next entry you're going to close is credits, and you're going to debit income summary. The third entry, you're going to close that income summary account. So you're going to have to figure out what the balance is. And remember, you can kind of scratch out a little income summary T account. That's helpful to me to just kind of see what's going on with that. It may be helpful to you. And then the fourth and final closing entry would be to close out your withdrawal. That's the only one you're going to close that's not in that income statement column. It's actually in the balance sheet column. It's right there. $7,500. It's a debit, so you're going to credit it to get rid of it. So that's just how you're going to go through those adjusting and closing entries. I think the rest of it, you're just going to post. Don't forget to put your balances in. The balances that you're going to get from these accounts, you can take them from the adjusted trial balance columns, which are right here, or you can find them on either the income statement or the balance sheet, because these balances on income statement and balance sheet actually came from the adjusted trial balance, so they're the same. So you can do it either way. And then post your entries from the requirement 1 and requirement 2. Post-closing trial balance. You're going to put your account names and your debits to those. And let's see. Looks like you only have here the adjustments. So for your post-closing trial balance, that one might give you a little trouble if you don't know where to get that from. So your post-closing trial balance is just a list of the accounts that have balances after you've closed, so, because it's post-closing. The accounts that have balances after you closed are your balance sheet accounts. So you're going to come up here to the balance sheet, and your post-closing trial balance should start with cash and then just list down what you have. The only difference is, remember, you closed this withdrawal, so it's not going to be on there. And this capital account is no longer $123,000 because you changed it. So when you get, after you get your assets and that liability of the accumulated depreciation, once you get all the way down to all the way through accounts payable and you start on your capital, then let's see where you can find that. I would go right here to Delva King Capital and find out what the updated balance is and put that in. It should be a credit. At that point, your post-closing trial balance should be in balance at the bottom if you do that. And what's Analyze say? How many accounts are listed on the adjusted and post-closing trial balance section? Well, the adjusted trial balance is here, so you just have to count on how many accounts have balances. On the post-closing, go back to the previous requirement 4 and just count. I had 10 accounts or 8 accounts or however many there was. That's all there is to it. So that's how you're going to tackle that problem. As always, if you have problems or you need help, feel free to contact me and I will assist you.